What if those familiar dividend checks you've counted on suddenly stopped coming, or were slashed in half just as you needed them most? In 2026, retirees across the country could wake up to exactly that shock as 7 popular dividend stalwarts confront cash flow crunches, expiring drug patents, heavy debt loads, and shrinking net incomes. These aren't obscure penny stocks or speculative plays. They're household names that generations of income investors have trusted to pay the bills. But trust alone isn't enough when underlying earnings falter or balance sheets buckle under rising rates and competitive pressures. Imagine having Whirlpool's 8% yield in your portfolio, only to learn its free cash flow can't cover the next payout, or owning Pfizer shares for that high payout, then watching it crumble under patent cliffs that send its payout ratio soaring above 400%. Picture drawing AT&T dividends into your budget, blissfully unaware that accounting maneuvers are masking toxic leverage beneath the surface. Or holding IBM, confident it will keep paying until its earnings retreat and leave no buffer for that generous 5% yield. Even real estate names like AGNC and Medical Properties Trust, offering double-digit yields, are guilty of burning through book value and padding distributions with unsustainable income. These companies might still declare a dividend next year, but a cut in 2026 could be just a corporate announcement away. No one wants to think their reliable income stream could vanish. Yet, every dollar of dividend relies on a sequence of financial realities that can shift overnight. In this video, we'll dive into the hidden warning signs behind 7 top-yielding names, revealing the cracks in their payout foundations, and showing you exactly where to look if you depend on those checks for your living expenses. Because when retirement income hinges on these dividends, being forewarned isn't just helpful. It can make the difference between weathering a market storm and facing a sudden, unwelcome drop in your monthly cash flow. You've probably seen Whirlpool's stock yield north of 8% and thought it was the ultimate income play, until you dig into the numbers and realize the payout outstrips the company's ability to generate cash. In the first quarter of 2025, Whirlpool burned through $793 million of free cash flow, equivalent to a negative 21.9% FCF margin on net sales, meaning the dividend is being paid out of borrowed money or past reserves, not fresh earnings. Investors.whirlpoolcorp.com, Guru Focus. Over the full year of 2024, Whirlpool managed $385 million of free cash flow, but paid out roughly $384 million in dividends, leaving virtually no cushion for 2025's planned $400 million in dividend payments, let alone any buffer for unexpected downturns. Investors.whirlpoolcorp.com, Q4 Capital. Even more troubling is Whirlpool's leverage. As of its latest reports, long-term debt sits near $4.8 billion, and although management aims to cut another $700 million in 2025, rising interest rates and ongoing restructuring costs could slow that progress. Market beat. When a company carries that much debt, any shortfall in operating cash translates directly into pressure on its dividend. Whirlpool's current payout ratio, dividends as a percentage of free cash flow, sits dangerously close to 100%. In a stable year, they might just scrape by, but any hiccup in housing demand or input costs could force them to choose between cutting the dividend or taking on even more debt. Don't let the headline yield blind you. An 8% dividend looks great on paper, but when it's fueled by negative cash flow and high leverage, you're betting on the hope that profits and housing markets rebound just in time. Retirees depending on those checks could find themselves staring at a sharp reduction in 2026, because when the payout can't be funded organically, cuts are all but inevitable. If you own Whirlpool for income, now is the moment to ask, is that yield worth the risk of being cut off? UPS's near 6% dividend might look rock solid on paper, but beneath the headline yield lies a payout commitment that consistently outstrips sustainable cash flow. And that gap could force a cut as margins tighten in 2026. Management's own guidance calls for only $5.7 billion of free cash flow in 2025, yet the company plans to return roughly $5.5 billion of that to shareholders through dividends and another $1 billion via share repurchases, leaving virtually no buffer for operating hiccups or rising interest costs. In practice, UPS has struggled to generate enough incremental cash. Over the last 4 quarters, analysts at Yahoo Finance noted occasional shortfalls where dividends and buybacks consumed more than 100% of quarterly free cash flow, a red flag for retirees who rely on that income being sustainable. Yahoo Finance. Worse still, UPS's debt load, nearly $40 billion of long-term obligations, means interest expenses eat further into cash that could have covered dividends. CEO Carol Tomé has defended the payout ratio by pointing to non-cash pension expenses that distort coverage ratios. But even excluding those accounting adjustments, the free cash flow to dividend ratio hovers perilously close to 1-to-1 Barron's. With package volumes under pressure from macroeconomic headwinds and competitive rate concessions, generating the promised $5.7 billion in free cash flow isn't guaranteed. Analysts at the Motley Fool warn that any slip in revenue growth or spike in operating costs will force a choice between slashing the dividend or taking on even more debt. Neither option seniors want to see for their monthly income, the Motley Fool. And given UPS's history of dividend raises, followed by periods of margin stagnation, retirees should brace for the possibility that the next increase could be the last, or even the prelude to a cut. Before leaning on that UPS dividend in your budget, ask yourself, is a yield fueled by such tight cash flow coverage really worth the risk of disappearing in 2026? Pfizer's headline yield of roughly 6.7% might look compelling on a retirement portfolio heat map, but the payout is dangerously outpacing the company's true earnings power, and with a blockbuster patent cliff looming in 2026, that dividend sits on very shaky ground. On a GAAP basis, Pfizer's dividend equates to more than 120% of its net income, meaning it's paying out every dollar it earns, and then some, with shareholders effectively dipping into reserves to bridge the GAAP coifin. Even when you adjust to free cash flow, the payout ratio remains perilously high at 86.6%, well beyond a conservative safety threshold and leaving almost no cushion for unexpected expenses or investment needs. Finance charts. This tight margin might survive in a stable year, but it collapses under the weight of looming patent expirations. Prevnar 13, the pneumonia vaccine that generated billions in revenue for Pfizer, faces U.S. patent expiration in 2026, opening the floodgates to generic competition and sending cold water on future cash flows. Biopharma dive. Without Prevnar's strong cash contributions, Pfizer's ability to fund its dividend hinges on the hope that new product launches can ramp up instantly. An assumption even management admits is strained given the long approval timelines and steep development costs in biopharma. Beyond Prevnar, Pfizer's top-line growth from COVID-related products has also waned, leaving a pipeline that hasn't yet produced a blockbuster to replace those revenues. That makes the current dividend less a reflection of sustainable earnings and more a bet on future R&D success. A gamble retirees can ill afford when their living expenses depend on reliable cash flows. In practical terms, if Prevnar revenues drop by even 30% post-patent expiration, Pfizer would need to slosh through reserves or cut other spending just to maintain the status quo at a payout ratio nearing 100% of free cash flow. It simply can't. Retirees should ask themselves, when the patent cliff hits in 2026, will your dividend check still arrive intact, or is it time to trim exposure before that income stream dries up? AT&T's near 6% yield looks like a cash cow for retirees. Until you realize the payout commitment soaks up almost every dollar of free cash flow and leaves no room for error. In its latest guidance, AT&T forecasts about $16 billion in free cash flow for 2025, yet management plans to return roughly $5.5 billion via dividends and another $1 billion through buybacks, placing total shareholder distributions near $6.5 billion, about 100% of projected free cash flow, seeking alpha. In other words, AT&T is banking on every penny it expects to generate, plus a bit more, just to maintain its payout. Digging deeper, critics point out that AT&T's first quarter 2025 dividend payout ratio soared above 75% of earnings, well past the 60% sustainable threshold many income analysts recommend invest. When a company commits 3/4 of its net income to dividends, it has little flexibility to weather rising interest costs, unexpected capital expenditures, or even a mild revenue hiccup. And with nearly $130 billion of net debt still on the balance sheet, even after recent asset sales, AT&T's interest obligations will only grow heavier if rates stay elevated. For retirees counting on that steady 28 cents per share each quarter, the risk is clear. If AT&T falls short of its free cash flow target by as little as 10%, it would have to choose between slashing the dividend, pausing buybacks, or loading up on more debt, none of which inspire confidence in your monthly income. Past patterns underscore the danger. Whenever package volumes slow or fuel costs spike, management has leaned on accounting adjustments and non-cash pension expense credits to cover the dividend, masking the true strain on cash flow. Yield alone doesn't guarantee safety. With AT&T effectively promising to pay out every dollar it plans to earn, a mild downturn or a stumble in broadband growth could force a cut as soon as 2026. If you're relying on those quarterly checks to pay rent or utilities, it's time to ask whether a payout so tightly pinned to its own cash flow expectations is truly risk-free, or whether your retirement income deserves a more durable source. IBM may tout its dividend aristocrat status, 30 consecutive years of increases, but the math behind the payout tells a far riskier story. On a trailing 12-month basis, IBM's dividend payout ratio sits above 110% of net income, meaning the company is shelling out more in dividends than it actually earns, Koifin. Even when you switch to a free cash flow perspective, a more reliable gauge of what a business can sustainably distribute, the picture remains grim. IBM's FCF to dividend ratio hovers around 51%, nearly double the conservative 25 to 30% threshold that income analysts recommend finance charts. Put simply, the buffer between what IBM brings in and what it pays out is paper thin. This dynamic leaves IBM with little wiggle room if revenue growth falters or unexpected costs arise. Although the company beat Q4 2024 earnings estimates, booking $13.5 billion in free cash flow guidance for 2025, analysts warn that sustaining that level hinges on the success of generative AI product launches and the completion of large acquisitions like HashiCorp, deals that come laden with integration risks and upfront expenses investors. If software bookings cool or consulting segments slide further, IBM could find itself diverting cash from strategic investments or debt reduction to keep the dividend flowing. Debt adds another layer of concern. IBM's long-term obligations exceed $60 billion, and while management has reduced the leverage ratio in recent years, interest rates remain elevated. In a rising rate environment, servicing that debt becomes more expensive and further encroaches on the cash that would otherwise fund dividends. With such high fixed costs and a payout consuming over half of free cash flow, any slip in operating performance could force IBM's board into an unenviable choice: cut the payout, suspend increases, or borrow more to prop up the yield. For retirees relying on IBM's reputation for dividend consistency, these figures should set off alarms. A 2.3% yield backed by earnings less than the payout, and with minimal free cash flow cushion, isn't a badge of safety. It's a warning sign that the next dividend announcement could be the one that finally breaks the streak. Before banking your living expenses on that quarterly check, ask whether a payout this precariously funded deserves a place in your retirement income plan. AGNC Investment Corporation looks irresistible with its sky-high 15% plus yield, but that payout is bleeding the company's book value faster than it can rebuild it, and 2025's Q1 results highlight just how thin the cushion has become. AGNC's tangible net book value per share plunged to $8.25 as of March 31st, 2025, a 6.7% drop year over year, driven by wider mortgage spreads and the carry cost of short-term borrowing that funds its agency MBS portfolio, AGNC Investors Nasdaq. Even worse, while AGNC collected 36 cents per share in dividends during Q1, those distributions consumed virtually all of its economic return, leaving scant room to absorb future rate shocks, Yahoo Finance. The mechanics are simple but brutal. AGNC borrows at floating short-term rates, now elevated after the Fed's rate hikes, to buy higher-yielding agency mortgage-backed securities. In theory, that spread nets positive returns, but when mortgage yields tighten or funding costs spike, the margin evaporates. Q1's economic return of just 2.4% underscores how little buffer AGNC has before that 15% yield starts coming out of its tangible equity. 24/7 Wall Street. As spreads compress further into 2026, especially if mortgage rates drift up or MBS demand wanes, the board may have no choice but to slash the dividend to stabilize book value. For retirees counting on AGNC's monthly 12-cent checks, the risk is clear. REIT paying out more than it organically earns can't sustain that generosity forever. Each month's dividend payment chips away at the net asset base, and AGNC's Q1 results reveal there's virtually no excess cash to cover whipsaws in rates or unplanned expenses. If you rely on AGNC for income, ask yourself, are you comfortable trusting a yield supported by next to no free cash flow cushion when the smallest market twist could put a permanent dent in your retirement paycheck? Medical Properties Trust's 7.3% yield might look irresistible on a retirement income spreadsheet, but a closer look at recent results shows the payouts foundation is dangerously thin and may not hold through 2026. In Q1 2025, MPT reported normalized funds from operations of just $81 million or 14 cents per share, down from $142 million a year earlier. Yet maintained a quarterly dividend of 8 cents per share, equivalent to a 32 cents annual payout. That works out to a payout to FFO ratio north of 1.07. Meaning MPT is distributing more than it earns in typical operating cash flow. ir.medicalpropertiestrust.com, Guru Focus. Even using adjusted funds from operations, AFFO, a metric that strips out maintenance capex and straight-line rents, the coverage ratio is only about 57%. MPT's Q1 AFFO payout ratio of 57.1% signals that nearly half of its dividend is coming from cash or asset sales rather than recurring property income seeking alpha. With book value per share down to roughly $7.93 and a net loss of 20 cents per share for the quarter, the REIT's ability to sustain its distribution hinges on consistent property acquisitions and favorable financing terms, both of which face headwinds as interest rates remain elevated and healthcare operators push back on rent increases. ir.medicalpropertiestrust.com. Medical Properties has already cut its dividend twice since 2023 and sold off non-core assets to shore up liquidity. Yet its current payout still consumes most of its operating cash flow, leaving scant room for unexpected vacancies or capex spikes. If AFFO fails to rebound, or if funding costs rise further, MPT will be forced into another cut to preserve book value. For retirees penciling in those monthly checks, the question is simple. Can you risk relying on a dividend whose coverage ratio hovers barely above the danger zone, and whose management has shown it must slash distributions when the math doesn't add up? If not, now may be the time to reduce exposure before a third cut arrives. When you look back across these 7 household names, Whirlpool, UPS, Pfizer, AT&T, IBM, AGNC, and Medical Properties, you see a common pattern. Yields that look too good to be true, financial metrics that barely support today's payouts, and looming pressures that could force cuts as soon as 2026. Whirlpool is draining its free cash flow reserves. UPS simply can't generate enough cash to cover both dividends and buybacks. Pfizer is racing to a patent cliff with a payout ratio north of 400%. AT&T is pledging every penny of its projected cash flow to shareholders. IBM is paying out more than it earns. AGNC is bleeding its book value with outsized mortgage spreads, and Medical Properties Trust is propping up distributions with shrinking FFO. None of these companies is immune to a sudden shift in margins, interest rates, or competitive dynamics, and when the next earnings release disappoints or a balance sheet constraint bites, retirees counting on that income could be left scrambling. You've worked decades to assemble a cash flow stream you can rely on. So don't let a headline yield lure you into a trap that can evaporate your monthly checks overnight. Dive into each company's free cash flow coverage ratios, debt levels, payout ratios, and pipeline risks. Ask yourself whether a 7% or 15% yield is worth the possibility of a 40% cut next year. Consider building a laddered approach, blending sturdier, lower-yielding equities with higher-quality bonds, REITs, or even annuities that have a track record of sustaining income through market cycles. And if you're grabbing yield from any single name, make sure you're not overallocated. No dividend, however tempting, should represent more than a small slice of your overall cash flow plan. Because when retirement depends on consistent checks, surprises become emergencies. These 7 companies may announce dividends in 2026, but whether those payouts arrive unchanged is anyone's guess. Staying vigilant, doing your homework, and building redundancy into your income strategy aren't optional, they're essential. After all, in the world of dividend investing, the only thing riskier than a market crash is believing that a high yield today guarantees a paycheck tomorrow.